It says we are live. And the portion that we have just covered is also on there on YouTube. So,
Okay, ठीक है.
yeah.
Sounds good.
Okay. So, continuing, these were the important disclaimers from our side. Now, I'll pass the floor to Vivek to take you over the rebalance update and the performance review as well.
Thank you, Simran. So first of all, I'd like to talk a bit about our gear-based philosophy. So, like in case of driving, whenever we are driving on a highway and there's very good visibility and very little traffic, in that case, we would like to drive at a faster pace, which means essentially means a higher gear. Whereas if, let's say, the road is not good or if there's not enough visibility, there's a lot of fog out there, in that case, we like to drive our car at a slower pace. Another thing is also that as a driver, how aggressive or conservative you are. Some people actually like to drive at much more faster pace, which means higher gear, and others are slightly risk averse and they choose to drive more conservatively. Similarly, it happens in the investments also. Your risk appetite ideally is a function of two things. One is your goals, whether your goal for which you are investing and saving is a near-term goal, say next 6 months or a year, or moderate term, which is next 2 to 3 years, or a longer term, which is say 5 year plus kind of goal, and your risk profile. So whether your risk profile is very aggressive as an investor or conservative or moderate. Based on that, you can actually invest in any of these gears. What is different here is just the asset allocation. So gear 3 actually starts with 100% equities and is meant for very aggressive investors. Gear 5 has 20% debt added. So 80 equity, 20 debt. So slightly conservative, which means the volatility would be slightly lower. The returns also would be slightly lower. So investors from moderate to aggressive risk profile can actually invest in this. Next comes gear 4, which is 60% equity, 40% debt, meant for moderate investors. And finally, we have gear 3, which has 40% equity and 60% debt, which is meant for very conservative or slightly moderate investors. Now, the important point to note here is that the equity part, although the equity allocation is different in all of these portfolios, but the same exact 15 stocks are present in these portfolios. So that would mean that if you invest, let's say 1 lakh in gear 6 and 1 lakh in gear 4, it is essentially same as investing 2 lakhs in gear 5. So there is no need to subscribe to multiple gear-based portfolios. You just take a risk profiling survey and whichever suits you best, you can just invest in that one specific Gulaq gear portfolio. The other way is, which many of the other investors also do, is they just take advice from us on the basis of equity. So they just invest in gear 6 and they manage their asset allocation at their end. So maybe they are investing in mutual fund, debt mutual funds, or they are investing in, say, FDs. But they are managing this asset allocation on their own. So that's another way you can invest in these portfolios. Okay. Yeah. So these are the weights specifically. Mostly we'll be talking about gear 6 because maximum number of investors we have is from gear 6. However, I will also touch upon the risk returns for other gears as well. So in gear 6, as you can see, the changes from June to July on the basis of market cap, we slightly increased our allocation to large caps and to small cap. And mid cap, we have slightly decreased our asset allocation. So not a big change really. It remains where it was last month. In terms of allocation to sectors, there is some bit of change. So financials, we have been constantly increasing. Start of this year, we were close to 0% in financial sector, but as of now, we are 24%, which is pretty close to where the allocation is in for BSE 500. So BSE 500 has 31% allocation to financials, and we are at 24%. So we increased it from June, in which it was 16%. That is the major change in terms of allocation. Another change is in IT also, it has increased slightly. May and June it was 0%, and currently it's at 4%. And the major decrease has been in communication services, where we have actually reduced from 11% to 3%. So there we are in line with the BSE 500 allocation. Yeah, this is the allocation to the multiple factors that we are following. So in July, it is at 60% value, and we are at 40% quality. So by the way, there's some mistake here. The percentage delta is not 2%, but it is 20%. So value has decreased, and the quality allocation to quality has increased from 20 to 40%. These are the returns for Gulaq Gear 6. If you look at in the shorter run, we are slightly underperforming, whereas in the long run, we have obviously delivered very good alpha. This year has been a tough year for us, where we have given a negative return of about 8% as compared to that of multi-cap index. We are down about 3.5%, whereas multi-cap is up 4.5%. Whereas in the longer run, the excess returns that we have produced, if you consider our performance since going live, we have delivered 45% CAGR as compared to about 25% in Nifty Multicap. So a very healthy 20% alpha is a huge alpha that we have generated. And this also includes the current year, where we are slightly underperforming. This is related to Gear 5. Again, the trend is similar. That past 1 year, because our equity allocation is same. Here also we are slightly underperformed in past 1 year, but over longer run we have delivered a good alpha of 33%. Same is the case with Gear 4. Gear 4 was launched slightly later, so it has about 2 years of track record only. And then we have Gear 3. Again, same is the case. Even if you see in Gear 3, last 5 years or so, since May 2020, we delivered about 20%. And mind you, this is a portfolio which has 60% debt. So a portfolio which is very, very stable with the 60% debt, and still we have been able to produce a pretty good returns overall. However, having said that, these returns look excessively good because the time when we launched, May 2020, was around the bottom of COVID times. So since then, market has also gone up, but as you can see, market has gone up about 25%, which is again very healthy alpha, but very healthy growth. But we in that same time has given 45%. So this is the overall returns for all our gear-based portfolios. Okay. Now, if you see the year-wise returns also, this is the first year, calendar year 25, where we are underperforming our benchmark. Whereas in past all those years, we have given very good alpha. Last year was again, we were matching the benchmark. So no alpha, zero alpha, but we matched the benchmark, and this year we are slightly underperformed. Now, this is a part and parcel of active investing, that any active fund that is trying to beat the benchmark, once in a while it is going to happen that these active funds do underperform from time to time. However, it should not be very frequent. So as you can see, in last 6 years, there's been one case where we underperformed. 1 year we kind of matched the performance of benchmark, and rest 4 years where we delivered pretty good alpha. Right. So at 45% CAGR, you can see that anyone who invested 1 lakh would now be sitting closer to 6.9 lakhs. whereas in the index, that same 1 lakh would be about 3 lakhs. Okay. Now let's move on to market cap based portfolios. Now we have quite a few experienced investors also who have invested with us, and who wanted to take an active call on sectors. So that's why we launched our market cap based portfolios in December 2024. So it's been about 6 months or so that we have launched it. Primarily, again, I want to emphasize that these are meant for experienced investors who do have the experience to really evaluate where they want to increase their allocation in terms of market cap. Right. The performance, I'll first touch upon the back-tested returns. So what is expected from large cap is that over 10-year period, this has generated about 7% alpha. Since last December, we are down about 12% or so in this. But obviously, over long run, we expect decent alpha from this kind of portfolio. In mid cap also, over past 10 years, the backtest results has shown us that we have been able to deliver about 9% alpha had we followed this strategy. In the past 6 months, there's been a bit of struggle and we are down about 5%. And same is the case with Gulaq small cap. Small cap is the one where we expect the highest alpha, which is about 19% or so. Whereas in last 6 months, we are down about 4% as compared to the benchmark. Now, this is really not to say that the small cap is the best portfolio because the 10-year CAGR is the highest. I don't really want to say that, because also the thing that is not coming across here is the volatility of these portfolios. Gulaq small cap, because we are investing in small caps, which has the highest volatility. So this specific portfolio is going to be, in terms of volatility, the highest volatile portfolio in our in overall our portfolios as compared to a mid cap or large cap as well, right? So to earn these kind of returns, one has to go through quite severe drawdowns as well at times. Now we have also been doing a lot of YouTube videos also and blogs on our website, which is gulaq.com. And these are some of the videos and blogs that we have done in the last 1 month. One is specifically how to select an index funds. A lot of our investors, and I personally also like to invest quite actively in index funds. A decent part of my portfolio goes into index funds as well, apart from the Gulaq strategies that I invest in. So in this specific portfolio, I talk about how exactly we can pick index funds on what basis, because there is a lot, all the index funds are not same, as we have shown in this specific example that HDFC Nifty 50 index fund gave 9.9%, whereas Taurus Nifty 50 gave about 8.8%. So there's a good difference of 1.3% as compared to Nifty 50 index in Taurus, whereas this tracking difference is just about 20 bips in case of HDFC. So there's a lot of index investing also hasn't remained simple. There are a lot of index funds. So here in this specific video, I talk about how exactly you should go about picking a specific index fund. This is on our YouTube, Gulaq's YouTube channel. Next is, I've also written a blog about 3 books that I really like and have contributed to a lot to my thinking about markets and investing. These are the 3 books. First one is Fooled by Randomness. I read it about, I think, maybe about 15 years back or even more. And it's quite a unique book. It taught me that success might be just luck. That was one of the biggest. And the way it's written is quite, again, very unique in the way it's written and also in the content. So quite an interesting book. Again, I started my career as a trader. So one book that I've read multiple times has been Trading in the Zone by Mark Douglas. And the biggest lesson here was, This book has a lot of interviews of very successful traders, and what really I learned from this is there's no single way that you can make money. Each one has to find out his own style of trading. It could be related to fundamentals, it could be focused on chart patterns, or it could be just reading the prices. Even that is a fairly good strategy. Some people are able, some traders are able to do it very well. So that is one thing. And another thing is also that it's really not about prediction, it's about risk management, right? So even a good trade can be screwed up if you really don't have a very good risk management. So again, this is a book that I've read multiple times, initially more so in the first 10 years when I was actively trading international markets. And the third book, which I read more recently, not recently, about 5 years back, was about The Most Important Thing by Howard Marks. And this, again, this is a book that more recently I try to read once every year, and I find something or the other new in this book. And this book talks about how price is the most important thing. So, a bad company could be a very good investment if you enter at a good price, whereas an excellent business could be a bad investment if it's at a very high price. So price is everything. And secondly, they always get deeper into the second level thinking. You've got to keep asking your questions when you are investing and try to approach it from the first principles basis. And that's how you become a better investor. Another blog that we have written is about process versus outcome. Again, this comes from my experience in trading where I would do a lot of analysis and take a really good bet, really good trade. And that good trade, according to me, it was a good trade, but it might end up in a loss. Or a really bad decision I could have taken, and for some reason, it produced it turned out to be very profitable. So, and this I saw time and again. And what I learned really was that your outcome in the short run is not necessarily a very good indicator of how good a decision it was. So, good decisions very frequently lead to bad outcomes, and bad decisions can lead to good outcomes. This is the role of luck in the shorter run. So, if you focus on the process, uh, then over long run, that's a much better approach than just focusing on the outcome. It also helped me really calm down my nerves during the trading experience, because I would also always focus on the process, always keep on improving our process, and the results in the short run could be profit or loss. But if your process is right, over longer run, the results would always be positive. Yeah. And this specific blog which we discuss the free float or the market cap based methodology of building an index versus another which is equally weighted. And as you can see, there's quite a bit of difference. In case of Nifty 50, if you see this equally weighted index in which all Nifty 50 stocks are given 2% weightage, has done fairly well as compared to regular Nifty 50, which is a market cap based index. There's good difference of 5%. And even in the case of Nifty 500, so Nifty 500 would have about 80% allocation to large caps, whereas in the free float methodology, whereas equally weighted would have just every stock would have about 0.2% weightage. So the top 100 stocks, which are the large caps, would just have about 20% weightage. So there's a good difference of 9% in this specific index if you had bought an equally weighted Nifty 500 index. So we discussed issues related to free float versus equally weighted ways of building an index. Yeah. So that's about it from our side. I'll quickly take the questions. We got few questions, and then be happy to cover any questions that you might have. Okay. So the first question is from Mahesh. I'm okay staying invested long term, but what's your view? Is compounding better or should I book profits? So Mahesh, I think if you don't need the money in the short run, I think compounding is always better. So whenever you need money, it has to be dependent on when you exactly need the money and start booking your profits maybe couple of quarters before that. But if you really don't need the money, just on the basis of market levels, that market is again closer to previous highs and it might again fall down, or any other such reason which is dependent on market levels, should not be a basis on when to sell, right? So far, this much amount has been deducted every 6 months. Total profit is this, upstocks charges, so net profit is this. I could have made a similar return in mid-cap mutual fund. Also, upstocks has unclear hidden charges on pledged securities. Okay, so I'm thinking of withdrawing everything and shifting to grow. So, Simran, can you take this one because this is slightly operational in nature? What if, and I think there's one more question by Makaran about shifting from one broker to another. So how can our investors shift from one broker to another? Can you take this one?
Yeah, it is possible to switch from one broker to another on your small case platform with your existing subscription. This is something that small case initiates from the back end, but there are basically two simple steps that you need to follow. The first one is that you need to exit your current investment under the subscription plan. So you'll need to hold zero positions before the switch. So you can do that by just opening the small case app and going to your investment page and click on exit small case. This will exit your holdings, but don't worry, it won't unsubscribe you from our advice. You will still continue to receive our rebalance updates and insights from Gulaq. It will just zero down your investments with us. The second step is then to write to small case team on their email, which is help@smallcase.com, and mention that you would like to switch your broker from broker A to broker B for your current Gulaq subscription. Usually, small case gets back to you between 1 to 2 days, but you can also mark our support email care@gulaq.com, and we'll follow up if needed be. So these are the two steps in which you can switch your brokers. But if you still have any questions, you can just reach out to our support team for any other operational queries that you might have. I'll just post both these emails as well on the YouTube chat for your reference.
But another thing also, Mahesh, if you're listening to us, I think here you have written that you are getting 10,600 has been deducted every 6 months. Now, I'm not sure. Please have a look at this because our fees for the 6 months should be 2,900 only. So where are these excess charges coming from? Please do check with your broker because it should not be, definitely not be this high, right? So do have a look at the detailed charges here. Okay, we have already covered this one, shifting as a subscriber to Gulaq Gear 6, the small cap portfolio. I noticed that this month's rebalance involves exiting an IT stock from small cap category while adding the same name to Gear 6. Yeah, so this is definitely possible. See, because in Gulaq Gear 6, uh, we have all the three large, mid, and small cap. And secondly, also the factors, the broader methodology of having a multi-factor model to select stocks, remain the same in both. However, those factors are specific to a portfolio. So the list of factors that work in a flexi cap portfolio like Gulaq Gear 6 versus the list of factors that work in a small cap portfolio are going to be different. And that's why you're going to have not the exact same stocks, small cap stocks, which are there in your small cap portfolio, and the same would be in Gear 6. That's not a certainty. So this could definitely happen because the factors used to construct these would be different. Sorry. So I think, yeah, those are the questions that we received. But Simran, let's take the questions if there are any other questions.
Yes, Vivek. So we have received a few questions. The first question is by Shribala Srinivas. I'm interested to know how to protect the capital by hedging the portfolio. Is good luck to plan any such implementation?
Yeah. So Srinivas, we have checked this specific uh, methodology of hedging your portfolio. So what happens in a hedging is there's some hedging cost uh, that is there. It's like an insurance, right? So if the markets are going up, then not then you still keep paying that insurance cost every year. But your returns, obviously, because you're paying that cost, your returns would be lower than the market, right? And once in a while, when market really crashes, that is the time when you're going to those that insurance or hedging is going to pay off, and those are the years where you really won't have that big a loss, right? You might have still some loss dependent on where you have put those hedges, uh, but it's not a very clear cut rule that hedging always improves your returns. It might slightly improve the overall stability of the portfolio, but not a certainty that it's going to increase or improve your overall returns. Rather, that is the cost that you will pay uh, to get stable returns, right? So it's not always that hedging is better or hedging would work. There could be actually could be a case, let's say markets have been going up since May 2020, markets have been going up for last 5.5 years, only past since September they're down. So from May 2020 till September 2024, almost 4.5 years or so, you would have been paying that specific cost every year. Maybe that cost is about 3, 4, 5%. um, and so it will really test your patience as an investor, that why are you paying this cost? If market is giving me, let's say, 25% returns, and I have hedged my portfolio and I'm able to make 21 or 22%. So I'm just earning that less 3, 4% returns every year. So again, that strategy is also very hard to practice for the years when the market keeps going up. So that's why we do not believe it's a straightforward call. And secondly, in this small case framework, also it becomes a bit hard. So as of now, we do not have any plans to get into hedging of portfolios. But you never know, if we are able to figure out a way to very effectively hedge portfolios also, and the cost is also low, then we might. But as of now, we do not have any plans. And as I told you, it's not that straightforward also, because when the markets are trending higher, that can happen for many, many years. And every year you're going to question your decision to actually hedge your portfolio. So it's not that straightforward.
The next question is by Vipul. So they're saying basically that the markets in the past year were tough, and if a strategy hasn't done well in this period, should that worry investors? Specifically pointing out to good luck.
Uh, I don't really think that is the case, frankly. See, if you pick any good fund, or for that matter, you pick Warren Buffett, who is considered to be the best investor in past couple of decades. Even if you see his track record, the overall track record is very impressive, right? But there have been years, and not only years, those years have, there have been maybe 5 to 7 years also, those kind of longish periods where he has underperformed. It's not only 1 year, I'm talking about 5 year track, over 5 year period. Also, he has underperformed. So as I told you, it's actually part and parcel of active investing. If you're really worried that one off year your fund is unable to beat the benchmark, and you expect that these active funds every year they are going to beat the benchmark, then I don't think you should be uh, getting involved in active investing. Not only with our fund, but other funds and mutual funds also. I think it's best that you get involved in index investing, that is the best approach. Otherwise, in all active funds, you're going to see this kind of smaller periods of underperformance. So it's really not a concern for me, at least. I personally have invested in these strategies, and that's what I say to all the investors, that active investment, one odd year, it is likely to happen. That is the same with next 5 years also. In next 5 years also, there's almost a guarantee that not all 5 years we'll be able to perform. There's going to be some period, 1 or 2 years, where we won't be doing as well. But overall, over a 5 year period, if we are able to generate alpha, then we have done our job well.
Great. Yeah. So the next question is by Ram. Can I believe Gulaq Year 6 blindly for 3 years to get decent return?
I don't think that's the right strategy, frankly. You should not believe blindly on any fund. And that's why we say that always diversify your bets, right? So break up all your equity investments in maybe 3 to 4 equal parts, not equal parts, but in 3 to 4 parts, and then invest. Because if you really want to blindly invest, then if you can do that, then there's no point in diversifying also. You might as well put all your money in Gulaq Gear 6. So see, no fund, no matter how good it is, um, you can trust on it blindly. So always diversify your bets, and this has happened in the past. I remember, see, past 1 year or so, our performance hasn't been good, but I clearly remember 1 year back when we had performed really well for past 3 4 years. There were many investors who really wanted 100% of their equity investments in Gulaq Gear 6. There were many, and they used to ask me, and at that time also my response was same, that it's always good to diversify your investments. Right.
Hope that answered your question, Ram. The next question is from Arun. Specifically for Gulaq Year 6, is there some maximum allocation to market cap, or it just depends on factors?
So there is no hard rule we have set that this is the specific allocation to either a specific sector or a specific stock. So that's not the case. However, we have seen historically what's the maximum, but we haven't set from our side that this is the maximum that we are going to have. No hard limit as such.
The next question is also by Arun. You mentioned about Nifty 500 index funds. Are those funds not, do these funds don't have too much diversification?
See, that's the point. If you need that kind of diversification, it does have. I don't really understand the question. Is it, are you referring that it has excess diversification? Is that the question?
Yes, yes, Vivek.
No, I don't really think so. It has excess diversification. See, it has diversification to large, mid, and small caps, right? And there are many companies. So when you say it has excess diversification, I think what you would mean is that it should impact the returns also overall. But since it has decent allocation to mid caps and small caps, which tend to grow at a faster pace than large caps, the BSE 500 would grow at a faster pace than typically than let's say a Nifty, than a large cap index, right? So I think that specific diversification across mid and small caps work in their favor. So as I told you, um, Nifty 500 gave 25% CAGR over last, I think this is 5 years, whereas Nifty 50 has given about 22%. So that's the kind of difference, maybe about 3 to 4% is maybe what you should expect over longer run for taking that higher risk with mid and small cap stocks.
The next question is by Manu. What is the optimum number of stocks in one's portfolio? I was an investor of Gulaq July 6, but exited when you guys increased the number of stocks from 15 to 36 suddenly, because that time my total number of stocks went up to 70.
Up to 70.
70 in total. Yeah.
It's really hard for me to answer what's the right number of stocks. In our case, we have now reduced it to, I think it's 20 now
We
or
are doing
15.
15. Yeah.
15 it is, yeah. So we again reduced it back to 15 because we were able to optimize uh, quickly, and we are able to get better sharp at 15. So we actually moved to 15 again, with the newer methodology only, which had lower churn. But it's very hard to comment how many stocks one should have. Personally, what I do is I almost never invest in individual stocks because I don't get that kind of conviction uh, in one specific stock. I get that kind of conviction uh, with the methodology. So, like we have Gulaq Gear 6 multi-factor methodology, uh, and I really believe in this methodology, and that's why I put some amount of funds here. And then I have invested in few other mutual funds and few index funds. So that's how I look at investing. I always say that individual investors should really not get into stock picking. It's a very, very hard thing to do, and most of the investors really burn their hands. There may be 5% of the investors who are able to pick stocks well and over long run do a better job. Otherwise, for the most 95% of the investors, it is that they should stick to either mutual funds or funds managed by professional investors like ours, right? So very hard for me to really comment on what's the right number of stocks one should have. But if it is 70 and uh, out of that 70, let's say, if that 70 number is individually managed by you, then it's obviously a very high number. If it is a part of, let's say, 3 or 4 portfolios, then I think 70 is not that big a number really.
Okay, the next question is by Pranav. I have one idea. Can it be one small case that constitute different category of ETFs? I believe this is like a suggestion that we should create a portfolio with different categories of ETFs.
So I think this is an interesting idea, but this would be similar to, this is one area of research that we have been doing. Uh, Instead of ETFs, we are coming out with a portfolio of mutual funds, right? So that's the difference. We believe there are not too many ETFs. The diversification is not that much. So we are definitely coming out with mutual fund advisory, in which we'll create portfolio of mutual fund, again gear based methodology. But ETFs, I'm not really sure, because there are not enough variety of ETFs still available in India. Yeah, so we've done this for mutual funds, but is there any other reason, Pranav, why you think we should do it for ETFs and not maybe for mutual funds? I'd really love to hear that.
While we await the response from Pranav, we can answer the next question, which is by Sahil. In back testing, what's the longest period of underperformance for Gear 6?
Now, this is something that I really don't remember, but if our team is watching and if you can quickly find out what is the longest period of underperformance, that will be great. But I don't remember, Sahil. Uh, but if you are unable to answer you right now, what we are going to do is we are going to look at our backtesting performance, and we're going to come back to you on this. Uh, what's the best way, Simran, to get back on this specific question? Can we directly message or through a blog? I'm not really sure. What's the best way?
We can definitely, if the person is our investor, we can try to find the details and reach out to them directly. But in case, Sahil, you're not one of our investors, um, I would request if you can write to our support email so that we can get back to you.
Yeah. And if we can find it out right now, we'll definitely
Yes.
share that. Yeah. Okay.
Yeah. So Manu just clarified that the 70 stocks that they held is not individually managed. All of them are part of different small cases, and now it's brought down to 42.
Okay. So see, if it is a part of multiple funds or portfolios, then it's really not that big a deal, because you might as well invest in, let's say, Nifty 500, and then you're getting exposure to those 500 stocks. But in that case, you'll be getting market returns also. And as I showed you in the blogs, one of the blogs, we have also covered that one way to maybe enhance that is go for equally weighted, in which case you will be getting more exposure to mid and small caps. So that is one interesting idea. You should really check out our blog. Uh, yeah,
Okay. So our team is working on it and sending the back-tested results soon, Sahil. So
great.
just be with us for some more time. Pranav just said that if this is for mutual fund, apart from the ETF, that's also fine. That's a good idea. In the meantime, if anybody else has any questions, we'd be happy to answer those.
So, Simran, I see this message from Sahil. He has written that he is an investor in with us.
Yeah,
So, if we can find out quickly, we can reply right now. Otherwise, we'll write to him.
sure. You can just wait for a couple of more minutes. The team would be
Sure.
just
Yeah.
sending the date. Yeah. We have one question by Shri Bala. If the portfolio is underperforming, is it good idea to add more at that time?
I am not really 100% sure. See, if the markets are underperforming, I really haven't thought about this. If the markets are underperforming, in that case, I personally think that it's a good idea. If you have excess capital, it's really a good idea. And you have that longer term vision also. You can hold for long term. Then it's a good idea to add more. However, if one specific portfolio is underperforming, even in that case, I think you can add, but overall, see, this is a personal rule. What I like to do is I've never gone uh, above 30% of my overall portfolio in one specific fund. So you should also set some specific upper threshold that no matter either because of its strong performance or weak performance, whatever the reason is, but you should not go above that specific threshold in any one specific fund. So if you are not going, if there is that limit and if you are not crossing that, then yes, you can add more in a specific fund also.
The next question is by Makaran. What happened if I sell any stock myself before the rebalance?
Nothing really. You can actually, if you want, although we don't want you to do this, the best thing is you follow this specific uh, portfolio. But if you really are selling a specific stock, then I think nothing really would happen at the time of rebalance. Uh, And if you have given a sell call after that, then those are not available in your demat, right? So in that case, Simran, you have any idea how exactly it will work in the case of small case?
I believe in the next rebalance, it will realign to the weightages if they consent to buy and sell all the portfolio, all the stocks as per
But
recommendation.
but see this specific sell transaction, small case wouldn't be aware about this sell transaction, right?
Yeah.
So in that case they got to inform small case that these are the transactions that they have done, and then it will be taken care of. I think that's how it happens really. But
Yeah,
I'm not 100%. Yeah.
we can check once with small case team on how to best handle this and get back to the investor. We have noted down their details.
Okay, great.
Shebal is asking if SWP can be explored for regular income.
Yeah, I think that's a good idea really, that if you need a regular income, then you can actually, there's no, because this is not a mutual fund, you cannot do SWP, but has to be managed on your own. That whatever you have invested for regular income, whatever you need, you should sell a part of your portfolio every month and generate that income. So yeah, that's how it should be done really. But this is not possible on small case as a platform. So it has to be done manually by the investor.
There are a couple of investors saying hello to you, Vivek, so if you want to just respond to them.
Yeah,
Uh,
hi. Hello, everyone. Kolu Gupta, this Punjabi gamer. Hi, hello, everyone.
While we wait for more questions to come up
Yeah.
and the bar tested results, Vivek, maybe you would want to share with us like one of the learnings that you have undergone while you started your investing journey since so long. So, what are the learnings that you can share with our investors so that they don't make the same mistakes as uh,
Many. I can talk all
yeah.
day about this, but I think the top of the list would be that as a trader, I always felt, and that was the case also as a trader, you have to really pick the top and the bottoms if you are playing for that reversal, because you usually don't have very high stop losses. So whatever stop loss you have to be very precise in picking the bottom as a trader. So when I started my investing journey, I used to do the same thing. But only later I made this mistake as an investor, that you really don't need to pick the bottom, right? So if let's say the market is going down for 6 months and you have done SIP, so every month market is going down, you have done SIP of whatever, let's say 10,000, 20,000. Every month you are buying more and more, you're getting more and more units because the markets are correcting, because you are a longer term investor. You don't really need to exit after 6 months, right? If you are just investing for, let's say, next 3 months, next 6 months, then you are always worried whether the markets would really recover or not, right? But if you are a long term investor, there's a huge advantage. When the markets are correcting, you really don't need to pick the bottom. You can keep on investing as much as you like. And even though markets have corrected, let's say 20, 30, 40%, over long run, you're getting in at really good prices. So the need that to time the market is really not there for investors. You can do really well uh, just by staying disciplined in investing. So that was one thing. That was one of the big learnings. Second is also that high income is not necessarily equal to wealth. So, in my case, I was doing pretty well as a trader, right? But I was not a very good disciplined investor. It was not a methodical investing. I used to just invest in, it was not a proper approach, frankly. So it did not translate to the wealth that I could have made had I been very methodical about it. So many times we think that if you are earning well, I am sorted. But that's only half the piece. If you are earning well, you got to invest also properly in order to really take advantage of that high income over longer run. So I think those are the two pieces of advice I have for now.
Thank you, Vivek, for sharing that. I hope the investors take some of it with them. So we have a set of new questions. The first one is by Golu. How to become a quant fund manager currently? I'm working as equity research analyst, and they want your guidance on it.
So I think I'm not sure really about the background, but what is really needed is to have good uh, analytical skills in terms of data and also good programming skills. So one has to be good at math or have to study a lot of math uh, and big data analytics and also programming. Those are the two things what is needed primarily. Those are two skill sets that are needed. So I think there are now good number of courses out there, online and offline both, which can really help you uh, gain entry and develop that kind of skill set for quant investing. So yeah, those two skill sets, I think math and programming is what is definitely you need to get good at.
All right. The next question is by Makaran. Why on each rebalance I have to add more funds? Why can't we rebalance in same funds we already invested?
So I don't really understand uh, this specific question.
Yeah, Makaran, if you can just elaborate more on what kind of issue are you facing? Because our minimum investment amount remains the same.
Yeah.
Okay, we can take the next question until then. Yogender, if I want to add funds in mid-month, can we not adjust the weightage as per that condition?
As per that condition, again, I'm not clear about this specific question, but you can actually add mid-month also. You can add and you can top up, and that top up could be a small top up of 5,000, 10,000 as well. So you can definitely add, and you can add, and the small case will be able to throw out the weightages or the exact number of stocks you need to buy with that amount, and in a single click you can actually do top ups. So this is definitely many investors do, so I don't really see any problem with that.
The next question is by Gautam. Growth or value, what will work for next 1 year?
So Gautam, that's the beauty of what we are doing. We are never into prediction. We never try to predict what could happen. We are always adjusting our portfolio. So if growth works well, I'm sure we are going to have our portfolios will keep on adjusting and giving more and more weightage to growth. And if value is what is working, then we are going to give more and more weightage to value. So that's how we always adapt. Our algorithms always adapt to the market conditions, but we never do really predict, because prediction is very, very difficult and it's not really required also. So we always try and adapt to what is happening, and we'll never predict. So, and yeah, so I don't have really uh, good view of what is going to happen. Yeah, that's how we have built our systems, also our algorithms, that we never really need to predict.
All right. The next question is by Makarand again. While rebalancing as per sell stock price and new stock prices, small case shows rebalancing cost. Example, selling 15K and buying 17K. In that case, I have add some more funds to my demat account.
Okay, I understand what you're saying, but this hopefully this will be a small difference. But this is the case. I think this is something that we need to take up with small case team, because the buying and selling algorithm is really handled by small cases end. So we can definitely get into this a bit deeper and figure out why it is happening, and maybe work with small case to fix this specific issue, this difference of buying and selling values. So we understand what you're saying now, but we'll need to talk to small case and figure out an exact solution for this. So Simran, let's note down this specific point and talk
Yes.
to small case about this. Yeah.
True. Vivek, our team has shared something regarding the backtest. If you can just have a look.
Yeah. Uh, so one sec, let me see. The question was for how long, uh, what's the longest period we underperformed? Okay. So that's not what we have currently. What our team gave was on a monthly basis, we have about 67% chances of outperformance. So there'll be about 33% chance that we underperform on a monthly basis. If you improve it to quarter or maybe year, this specific chance of underperformance keep on reducing. So for monthly, this is 33%. For quarterly, this might be closer to say 20%. And for a year, it might be somewhere between 10 to 15% chances of underperformance. So about 80 to 85 to 90% chance that we will outperform. So that's the probability of success over different time frames. But I think the question is very specific, that what is the longest period of underperformance that we haven't been able to get. It might take some more time. If we have more questions, I think we can take that. Otherwise, we can find it out and then email the investor.
Yeah. So, Sahil, this question was asked by Sahil. We'll get back to you on this and email you the response. As it will take some time for our team to collate all the data and provide it to you. I see there are no more questions. All right, I think we can end the session. Thank you so much for joining, everyone. Thank you, Vivek, for your time, and have a good night, everybody.
Thank you, Simran. Thank you, everyone. Bye.